Hi everyone, welcome to Phillip Securities Research Monday morning call. Today, we will be going through Elite UK REIT's stock counter update, S&P 500 technical analysis, and our Singapore equity strategy. General disclaimer before we start: the information provided in this seminar is solely for educational purposes and does not constitute a financial advice. So let's begin with our first counter update, Elite UK REIT. So some background on Elite UK REIT before we start. They have 150 properties across the UK. Majority that is leased to the Department of Work and Pension, and they are currently trying to diversify a small part of their portfolio into purpose-built student accommodations in Scotland and London. And there are two main updates from them. They have about 95% of their leases that are expiring in 2028, and we are expecting they are currently also doing a negotiation on their lease regearing, and we are expecting uh, regearing outcome to be released in 1Q26, so pretty soon. We are expecting a third of their portfolio leases to be renewed in 1Q26. Um, Based on previous rental reversions, we are looking for a mid-single digit to low double-digit rental reversion. So based on past renewals, which we took a look at with theatre buildings, they had a 5% rental reversion. And with the renewals with the Home Office and the HM courts, they had a slightly higher rental reversion, about double digit. And currently, their weighted average lease expiry is about 3 years. And post regearing, the already low risk profile for Elite UK REITs tenant will be lower, and we expect for a cap rate compression that can justify a knock-on effect on gearing. Currently, their gearing is trending at 42.5%, and we're expecting it to be about a high mid 30s. Market fundamentals in the UK for what we are observing is that there is an increase in unemployment rate. Currently, according to their latest statistics, for the past 3 months ended October 2025, their unemployment was about 5.1%. And this is largely due to an increase in the supply labor force rather than job cuts. And for their largest tenant, DWP, we expect that because they are not only handling pensions but also ensuring the job security of new graduates, there will be continued demand for their services. And when the next update we have for you is the Lindsay House PBSA repositioning, which is currently in progress. So strip out works have commenced. Currently, they are looking at 15 to 17 million capex for the conversion. So this particular PBSA is located near the University of Aberdeen and University of Dundee. So market fundamentals for PBSA in Scotland, there is a structural undersupply, about 4,000 plus beds to international student population of about 73,000. So there is a big gap which we think Lindsay House can benefit from. So cap rates for PBSAs in Dundee, according to management, is between 5 to 7%, and we are expecting a yield on cost of about 7% for Lindsay House. So why we like the stock? Their tenant DWP is a low risk tenant. There's always going to be a demand for their services, and post regearing, the low risk profile of the portfolio is going to be even lower, and we think it's a great stock to look at. And apart from that, they also have a high forward dividend yield, about 9%. So that's uh, relatively high compared to other REITs that you would have in the market. And for that reason, we have a accumulated recommendation with a TP of 39 cents. Next, I'll pass on to Zain.
Thanks, Hashim. Good morning, everyone. I'll move on to the technicals. Next slide, please. Yeah. Okay, so this is the chart of S&P 500. So last week it was up 1.5%. So in terms of the chart, there was a breakout of the key resistance at 6,920. So this was following higher lows along the way since middle of November and multiple retests of the 6,920 level. So I think with that, we are likely to see higher highs going ahead with the next key resistance level at the 7,000 milestone to about 7,050. And support is currently likely to be at 6,900 to 6,945. So 6,900 was the swing low for on Thursday. That was which is confluent the 5 and 10-day SMA levels as well. Next slide, please. So I'll go through a summary of our technical calls initiated last week. So for the buy for Hang Seng Tech ETF, it was down 0.4% as of Friday. And for the buy for ASL Marine, it hit a stop loss, so it's down 8.6%. For the buy for Keppel, it's currently in progress, up about 0.3%. And for Weher, it's currently in progress as well, up about 2.5%. Next slide. Next one for Yangtze Shipbuilding buy. It's in progress, currently slightly down 0.5%. And the buy call for Pacific Radiant is currently flat as of Friday. Yeah. Next slide. Yeah, so that's all from me now. I'll hand over time to Paul, who will give us a summary of our Singapore equity strategy, which we held last Saturday. Thanks.
Yeah, thanks, Zin. So customary, whenever we complete any strategy and stock picks, we will follow up with a summary on the following Monday webinar. So today we're just going to go through some of the key highlights of our presentation. Our theme for 2026 is that we think it's going to be a fertile environment for equities in 2026, especially for Singapore. Next slide. So just to recap the performance of the Singapore market in 2025, the market was up about 23%. The prior year, 2024, about 17%. So you combine, we almost had like about 40+% returns the last 2 years. This is the best performance 16 years. And if you look at the last time we had such good returns was in the 2003, 2007. So what were some of the thematics during that time? You had the marine sector recovering, the usual Swiber is not around anymore, Easier not around anymore, Ezra. And then we had S-chips phenomena, and then we have the integrated resorts coming up, and then we had the strong property sector. So for this time around, we also think there are some thematics that will keep because you need investment teams to keep the market up. So we think that lower interest rates, the asset monetization continues, and also sustainable dividends, especially by the banks, and also property sector is recovering, and also we have, more importantly, unprecedented, we have the EQDP where MAS is putting money into the stock market. And for us, from the peak of 2007, the highs of 2007 till now, the market is up about 20+%, which you analyze it, you're talking about 1.1% return for the market since over the past 18 years. So we don't think that the market is like overbought and so forth. Next slide. In terms of some the reasons why we think the conditions are positive for equities, we have a benign environment. So economy is not too hot, not too cold. If it's too hot, then you worry the Fed might raise rates and then punish the market. And it's not too cold, obviously, then there's risk of recession. So it's just about right. Referring more to the US economy and global economy. Of course, lower interest rates. This is very pertinent for Singapore. So for Singapore, the interest rates have totally crashed, and this will only make equities more attractive. Interest rates down almost 185 basis points. It's like we always say, it's like the Fed cutting interest rates by 7-8 times. And this will support valuations, and interest rates actually continue to drop. If you read our bond weekly, actually the SORA is still coming off to the lows. And this will support valuations. Our Singapore market bond dividend yield is about 5% plus, and then the earnings also will support earnings growth if interest rates are down, especially for REITs, which Darren will talk about it later. The next driver for equities for Singapore, this is the 5 billion EQDP. So far, 1.1 billion probably has been deployed. 2.85 has yet to be deployed. But critically, we view it very holistically that not only is money coming in, you have many departments, many agencies, maybe many ministries all looking towards really supporting or not propping up, but at least supporting and reviving the whole Singapore market. So this is unprecedented. And what usually happens is that if you have a liquidity trap in the domestic market that is just circulating around, you normally create a liquidity premium. This is what we see in some markets like Malaysia, where valuations are always elevated, but that's because there is domestic liquidity dedicated for just the domestic stocks. So this will be especially supportive for small mid-cap stocks, which we are beginning to see all the valuations start to re-rate higher. We also have multiple investment teams. You still need investment teams to support the stock market, which we will go through later. Next slide. So one of the key investment themes, which is more towards the large cap stocks, is the asset monetization. We kind of think of it like a home power draw. The earnings are growth. They give you ordinary dividends. Then once in a while, they'll top it up with some special dividend or special share buyback. So what is upcoming? We still think there's asset monetization coming ahead. For Singtel, there's at least 8 billion. They have a 6 billion stake in Bharti Airtel listed in India, which they want to equalize. So that means to equalize, to have an equivalent stake with the other major shareholder of Bharti Airtel, which is Bharti Enterprise. So a bit confusing, but basically Singtel's shareholding is larger than the next shareholder, so they want to equalize it, make it equivalent. So if that happens over time, you're talking about at least 6 billion worth of shares that they can sell. Then the other, they used to be in touch. There was a merger. Then they have another 2 billion stake in this thing called Gulf Development, which is about 7% stake. So it doesn't give you anything, very small dividend. So it's only right that they to realize the value, they will eventually sell this to. So there's another room to monetize. And Singtel has a 2 billion share buyback, excluding all this that they haven't really started yet. The next is Sembcorp Industries. There is a 3 billion of they have mentioned that they want to monetize renewables, so we think they will look towards listing their assets, renewable assets in India, which we don't have the exact value, but if you just look at the book value, you're looking at almost 3 billion of assets they could monetize and get better valuations in India. Then, of course, Keppel has been asset monetization for the last 2-3 years. There is another. This year, they need to monetize almost 3 billion to hit their target of, I think, 10 billion. And then they have almost 9 billion. A lot of it is property, large part in China, but they will also monetize some of it. And monetization is a powerful theme. I guess those who monitor Hong Kong Land, you will notice that that was probably the poster child for monetization in 2025. Next slide. Of course, interest rates, I won't dwell too much, but this is just the blue line is basically the chart of where interest rates are heading. So you're looking at 2 rate cuts in 2026 and probably flattening it out. The bond market, which is the green line, doesn't seem to agree. I think the bond market is more like pricing in interest rates won't move. So why is a 2-year bond market? If you look at the green line, the bond market has some predictive behavior. If you look before the Fed started to raise rates, the 2-year bond yield, which is the green line, already started to creep up. So right now, it's actually not pricing in any rate cuts. But for us, we still think there will be rate cuts because we still think the job market is weak. Of course, we have a change of a Fed, and with midterm elections, I think the pressure is on. I think like Trump obviously wants lower interest rates to improve affordability and so forth. Next slide. Okay, the next type is capex-driven earnings cycle. So there is earnings growth when we meet with so many small mid caps. I think the largely these are some of the thematics if we were to group around them. AI investments. This is affecting more the data center builders like Keppel, Singtel. So there's going to be another batch of data centers going to be issued out. I think it's 300 megawatts if I'm not mistaken. Of course, we have another 700 megawatts coming up from Jurong. So all this will be positive for Keppel and Singtel. They have an opportunity to build it and to generate earnings out of it. The next batch are the more small mid-cap stocks like system integrators like TeleChoice. We think they're going to pivot more to data centers, and of course CSE Global, where Amazon recently took a stake in them because they want access to the ability to supply power switchboards, which is like your switchboard at home, but these are container size and like 5 to 6 containers in each data center. Renewable energy spending is another theme that's supporting small mid caps. which is the offshore wind installations. So offshore wind is like, your offshore wind farm. It's happening in Taiwan, which is supporting companies like Marco Polo and Pacific Radiance. But this is the only first country. The next countries will be South Korea. Then we'll move on to Japan. The next renewable energy, which is sustainable aviation fuel oil, which you're putting in used cooking oil or maybe used or palm oil effluent into jet fuel. So Singapore has a mandate 1%, which is huge. I mean, because the jet fuel demand is so large. One of the beneficiaries is Alltech if they can secure some of the contracts. Domestic capex, I think this is nothing new. So this is domestic capex means no construction activity in Singapore. So we have public housing, which is a record high. We have an infrastructure, including hospital, Terminal 5, and so forth. So this Yipan will elaborate more. The other thing that we think is coming up is a healthcare commercialization. So we see companies like IX Pharma with their drugs starting to commercialize after spending hundreds of millions on all this infrastructure. Likewise for Singapore Institute of Advanced Medicine, which spend millions on a photon beam therapy for cancer. But of course, you spend all this upfront, you're going to have a lot of losses. So we think this year onwards, you're probably going to see some fruits of our commercialization of all the infrastructure and all the money spent on these drugs or infrastructure. Next slide. I will hand over to Zane to discuss on technicals.
Yeah, thanks, Paul. So I'll move on to the technicals of the Singapore market. So first up for the blue chips, this is the chart of the ES3 ETF. So it's showing acceleration in terms of the bullish ascent starting last week. So in terms of the quarterly performance, it locked 7 consecutive quarters of gains. Fourth quarter 25 was up 8.3%. So starting this year, I think we saw acceleration in the bullish momentum where it broke out above the $4.75 level and currently trading above the uptrend channel it was in since July of last year. So with that, we see the bullish momentum to continue in the first quarter this year towards potentially the $5 level. So that will be about 3.7% upside as of Friday's close. Next slide. Next one, we look at the mid-cap index. So for the mid-caps, it's also performing well since the breakout quarter in July last year. And last quarter, it was up 2.8%. So that makes it second consecutive quarter of gains. It was mostly consolidating within an ascending triangle formation. And the resistance was at 750. So start of the year, this year, we saw a breakout of this resistance. So with that, likely we are to see it going towards the next key level at 779, which was the previous resistance all the way back in April 2021. So that will be about a 2.8% upside from Friday's levels. Next slide. So next one, I'll give the technicals for the large cap as well as small cap picks. So first one is on Keppel. So for Keppel, we think that the chart is still showing a very strong bullish uptrend with a fresh breakout of this bullish flat consolidation recently. So starting from June last year, it was steadily trending higher in the uptrend channel. And then subsequently, it consolidated sideways between $9.89 to about $10.38, starting from the end of October. And then start of this year, it managed to break out this $10.38 resistance level to actually make a new high. So with that, we see upside ahead to actually head towards potentially $11.92 to retest this uptrend channel resistance area, as well as it will be the projected target level of the bullish flag breakout. Yeah, if you take the height of the flagpole, project it onto the $10.38 level. So that will be a 13.8% upside from Friday's close. Next slide. And next one for mid-cap pick, we have WeHer. So for WeHer, we see the chart as a fresh breakout of ascending triangle consolidation. So the price action looks kind of similar to the breakout that occurred in July last year. So recently it was consolidating in this ascending triangle from September onwards with a key resistance at 78.5 cents. And there was a breakout of this resistance in last week. So with that, we see it extending its uptrend to head towards the next target at 94.5 cents level. that would be the projected target level. We take the height of the ascending triangle projected onto the 78.5 cents level. So that would be 17.3% upside from Friday's close. Yeah. So that's all from me for the technicals. I'll hand over time to Glenn, who will share more about the Singapore banking sector. Thanks.
Yeah, thanks, Zain. Yeah, so we're going through straight away to our top picks, basically. Our preferred stocks for the banking sector will be two of them, DBS and OCBC. So firstly, for DBS, why we like DBS? Mainly because of their capital return and dividend plans. So firstly, their dividend is the clearest amongst all three banks. They are the only bank that will give based on absolute dividend per share instead of based on earnings. So, like 50% or 60% kind of dividend payout ratio, they are saying, no, we will just give you the amount, right? And that's very clear to us. And secondly, they are also the only bank that has really provided guidance or given any clarity on how would they be returning capital all the way until the end of 2027. So with that, we have plotted out the dividends here. We believe that they will be able to give the ordinary dividend step up of the 24 cents even in 2027. So they have only committed it until the third quarter of 2026, but we believe that they have enough room to continue that. So we're looking at FY27 dividend yield of 6.1%, and then FY26 is around 5.9%. Yeah, so that's the reasons why we like DBS. Now moving on to the next slide, the counter that we like OCBC for two reasons. The first reason is because of their very strong wealth management and fee income growth. It's at high double digits in the last quarter. It's actually surpassed DBS's growth in terms of wealth management, and it's the strongest amongst all three banks. And the second one, and the most important one, is that there's an upside surprise to their excess capital. So we did some rough forecasting estimation, at least all the way until 2030. If they continue to maintain their earnings, so let's assume their earnings is flat in the worst case scenario, and they don't give back anything to shareholders or to spend their excess capital, they'll keep accruing their CET1. Right, so CET1 will reach rough estimate of around 21 to 22%, and that's their optimal CET1 is actually 14%. So we're looking at around 8 percentage points kind of excess capital, and every 1% is equivalent to $2.7 billion, or if you break it down to a dividend per share, it will be 76 cents. In 2025, we expect them to pay about $1, so it's around 75% of 1 year's worth of dividends. Right, so that's why we believe that they will actually be able to continue with their capital return plans, of which currently it's a 10% dividend payout ratio extra, or 16 cents. Yeah, so we believe that they can actually continue to pay because their retained earnings will help to top up their excess capitals. Yeah, so they haven't announced anything yet, but we believe that they will be able to do it. Yeah, moving on to the next slide, we'll be looking at the conclusion. So from conclusion-wise, just a quick recap on the third quarter earnings. The earnings did fall because of the NIM compression, from the collapse in the interest rates, and this affected their net interest income. But the loans growth and fee income did help to partially offset some of the decline in net interest income. So we saw earnings not decline as quickly as we expected. For 2026 outlook, we believe that the margins will continue to decline and net interest income as well due to the lower rates. But why we believe that earnings will grow by a moderate pace of around 5% is because loans growth will help to offset that dip in margins, in the compression in margins. So this will help to buffer up the net interest income, and more importantly, that the non-interest income or fee income will actually help to bring up earnings growth. So we do like DBS and OCBC for the reasons I said earlier. And I guess I'll get some questions about it, but why we didn't put UOB in here was mainly for two reasons. First one, they are not, like OCBC, they're not very clear on their capital return plans. They haven't said anything. And they're also very strict on keeping to their 50% dividend payout ratio. And the second reason is also because, they have, I think their mind is now, like the focus is on allowances, right, and provisions and trying to boost up their coverage ratios. So that's the reason why they maybe may not be concentrating so much on returning capital. They rather put it to trying to buff up their allowances coverage. Yeah, so we don't see much upside surprise, them actually extending or giving out more of their capital to shareholders. So that's the reason why we didn't put UOB in here. Yeah, so that's all for the banking sector. I'll now hand it over to Darren for the REITs. Thanks.
Yeah, thanks, Glenn. Yeah, so let me run through the REITs. So first of all, this is the forward dividend yield and DPU chart. So the shaded region basically is the DPU growth that we see. So the beige one is negative DPU growth from 2020 to 2021. We saw that's because of COVID. Then 2023 to 2025, negative DPU growth because of high interest rates. And 2021 to 2023, the DPU grew because of the low base from 2020 during the COVID era. So the one that we see on the far right, after 2025, is in pink. So that is a 1% DPU growth that we're expecting this year. So that's from lower interest rates mainly, as for the first half of 2025, we already saw 40% of the REITs already experienced DPU growth. About 70% have experienced year-on-year interest rate declines. So going forward, we expect more of these REITs to experience more interest savings or finance cost savings, and even more REITs to experience deep interest rate, lower interest rates as well, lower interest costs. Yeah, so that will help to benefit DPU growth. Yeah, so previously, most of because the 3-month SORA has already fallen so significantly, now it's like 1.2, 1.1%. So it's like basically 180 to 200 basis points lower year on year. So they benefited from the lower base rate. So from the floating portion of that debt. But going forward, those who have debt that are due for refinancing in 2026 or 2027. So they will benefit from refinancing at lower base rates, as a lot of the debt that they took perhaps 2-3 years back when interest rates were at a high or peakish. Yeah, so going forward, that will be the new kicker for lower finance costs. Yeah, so we see the chart basically here, the line is below the historical average, just mainly because of the 10.6% growth in share prices for REITs. So that's why the dividend yield fell. But basically going forward, we expect the absolute DPU to continue to increase from lower interest rates. And this forward dividend yield will continue to, will improve. That's our view. Yeah, next slide, please. Yeah, so next is the S-REITs dividend 10-year dividend yield spread. So this is the forward dividend yield chart, a graph that we saw just now minus the 10-year Singapore government bond yield. So we can take the 10-year government bond yield as a proxy to the risk-free rate. So that's like your fixed deposit rate or risk-free bond or yield instrument. So right now, if you are investing in S-REITs, you are getting about 3.6% dividend yield spread above the so-called risk-free rate. So we think that is attractive, and considering that the potential for DPU growth is very high from lower interest rates, like I mentioned. So the yield spread will continue to widen in our view, and that will make S-REITs even more attractive. So this 3.6% is very attractive in our view. Yeah. Next slide, please. Yeah, so moving on. So we have a few REITs topics. So one of it is Stoneweg, Europe Staple Trust. So right now, after their 400 million divestment over the past, since 2022, they set up to divest 400 million euros worth of assets to keep their balance sheet in check, like to keep gearing around 40% because interest rates are rising. So the issue, they don't want to face a similar issue to like what some other REITs face, like Manulife, for instance, where because the asset value really declined, so the gearing was breached. So they set off for this 400 million euro divestment since 2022, and that has largely been completed as of 2025. So they divested already 400 million euros and at a premium of an average of about 11% to book. Yeah, so that's a very solid track record that they did. Yeah, so that is behind them. So going forward with lower interest rates, because they've already refinanced all their loans, so they do not have any debt due until 2030. So they are looking at the next stage of growth, which is basically acquisitions and inorganic growth. So with lower interest rates, that will likely to, or rather it's easier to get creative acquisitions. And not to mention that they have a lot of potential for significant upside for the NAV, as they they have a 50 million investment in Ionics, which is a sponsors data center development fund. So as that gets developed, the 50 million will likely increase over time. Just a few days after they invested this 50 million euros, it really became they really registered a 50% valuation gain, or so-called NAV upside, when it got revalued few days after the acquisition. Yeah, so going forward, we continue to expect that. And most importantly now is that their portfolio remains very resilient. As you can see here in the chart, this is their portfolio occupancy. It's been really stable over the past, basically since IPO. Even through COVID, the portfolio occupancy remained high, and through the Russia-Ukraine war, it also remained high. So around 93 to 95%. So we expect this to continue. So we expect resilient earnings from there. And we do expect DPU growth in 2026 as well, as interest rates have already peaked for them and they have very resilient operations. Yeah, and not to mention that recently they've been buying back shares and they're also cancelling shares, so the reduced share base will help to improve DPU growth. Yeah, so that is for Stoneware REIT. We also like that, especially for the fact that it's for the high yield. Yeah, so next we have Prime US REIT. So this is more of a share price upside potential type of play. Not so much dividend yield, but because they're trading at about over 60% discount to their NAV. Yeah, so going forward, because 10.8% of the occupancy has yet to commence any cash contribution from the current 80% occupancy. So basically, you see in the numbers, the distributable income, only 70% of it is accounted for, basically. Yeah, so going forward, as that continues to increase, as the rent-free periods fall off from all the large leases that they signed recently, yeah, we expect the distributable income to increase. And with their recent announcement that they'll pay out at least 50% of distributable income as DPU going forward, yeah, the DPU will basically increase. Yeah, and right now the occupancy is at 80% as of the third quarter, but by year end we expect it to increase to about 85%. So we expect some good news by the financial 2025 results, and we expect occupancy to increase to 90% by 2026. Yeah, so right now, assuming a 50% payout ratio for second half 2025, we are looking at about 3.3% dividend yield for FY25. That's because in the first half of 2025, the payout ratio was only 10%. So in 2026, when they kind of fix on the 50% payout ratio throughout for the full year, and then we are looking at a 6.6% dividend yield. Yeah, but we think there is a lot of value here, especially they're still trading at a steep discount of over 60% to NAV. Yeah, next slide, please. Yeah, next we move on to property. So for property, yeah, we like them because there's still a strong pipeline of launches that are upcoming in 2026. So in 2025, there were about 11,000 new units launched. And in 2026, we're expecting upwards of 8,000 units from 20 projects. Yeah, so first of all, we like CDL because of their ongoing asset monetization. In 2025 itself, they divested 8 properties, unlocking about 2 billion in value. So the biggest one was South Beach, and going forward, we do expect this divestment momentum to continue. So as they divest some of the mature assets, as well as some potential UK land sites that they acquired previously. And also, not to mention that their property development sales remain very strong. Like in 2026 or in 2025, they had the Ori, which is now almost completely sold, over 95%. And Zion Grand also, the Zion Road development, which saw over 80% take-up rate also. And going forward, they have a strong pipeline, development pipeline of over 1,000 units. And for CLI, we like them because of the asset-light model and their growing recurring fee income. Right now, their FVM is at 120 billion. We expect this to continue to increase to hit their target of about 200 billion by 2028. And with low interest rates, transaction activity, we expect it to increase significantly, and that will help to increase their event-driven income, as well as it will be easier for them to raise funds and seed new funds with the lower interest rates. Yeah, so we do expect that there are some tailwinds for CLI going forward. Yeah, and lastly, we have PropNext, so I'll speak on Paul's behalf. Yeah, so the pipeline of launches remains very strong. Like I mentioned, there's over 8,000 launches in 2026, slightly lower than 2025's 11,000. And largely, most of the new launches are in OCR region. Yeah, and the thing we like about PropNext is also because we don't think there's any risk of government intervention or any cooling measures, as in 2025, the full year property price, it rose by 3.4%. So that is at the slowest pace since 2020, COVID 2020. So we don't think there's any risk of any cooling measures for property. And the supply also in 2025, there were 9,800 units in the confirmed list. So that is way above the pre-pandemic average of 4,600 units. Yeah, so that's all for me. I hand over time now to Ikpan to talk about construction. Thanks.
Yeah, thanks, Darren. Yeah, hi. This is our overall coverage on construction. So for the first counter, BRC Asia. For those who are unsure, they have a 60% market share in steel rebar being used in construction projects. So over the course of this year as well as next year, we do see steel rebar volumes ramping up. This is because the amount of contracts being awarded are at very elevated levels now. For the most recent October itself, it increased by 8% year on year. And currently, BRC Asia also has a significant order book of $1.9 billion. So this is 37% higher year on year than the previous announced. I mean from the previous year. And we do see in terms of future contracts coming from HDB BTOs, because as a minister also mentioned last week that they are also looking to ramp HDB BTO supply because of the huge demand. Other projects also include Changi Airport Terminal 5 tunneling projects, because they have recently tendered out the substructure projects, which means like the foundation projects. So now they will increase the tenders for the tunnels itself. And for those who are unsure, actually Terminal 5 is such a huge project because it is 2 times the size of the current Terminal 1 to Terminal 4 combined. So we keep talking about Terminal 5 is because it is a project at such a large scale. We are also looking at MBS integrated resort expansion projects coming up. I think by the fourth quarter of last year as well as this year itself. So we can also look forward to that. And additionally, there's also hospital tenders which are upcoming. Yeah, so these are the kind of future contracts we can look forward to for the entire construction industry. Yeah, next counter for Pan United, also similar story to BRC Asia. Pan United is also a building material counter. They have a 40% market share in ready-mix concrete itself. Yeah, so we do think that there will be higher ready-mix concrete ramping in the next 2 years as well. And Pan United has also experienced higher margins because of their in-house technology platforms. It's called Air Digital. So with this platform itself, they are able to reduce, for example, one example is to reduce truck queuing times. When the trucks are queuing to load the ready-mix concrete into the project site itself, they are able to optimize the time itself. So this increases their operating margins. And we are already seeing this performance in their previous earnings itself. So we do think that this trend will still continue. And we have a buy recommendation on Pan United. Next up we have WeHer. They are counter in the construction as well as worker dormitory sector. Recently last year they have won two separate contracts from HDB BTOs, which are worth $400+ million. So this brings their construction order book to record levels of $629 million. And we do think that this will support their recurring revenue from now till 2029. And we can also look forward to a 47% increase in their worker dormitory beds by the fourth quarter of last year itself. So this increase in 7,000 worker accommodation beds should continue to support their recurring growth. And WeHer has also announced some portfolio pipeline which continue to support their share price. For example, they have won the $600+ million GLS site in Upper Thomson. So if they, I mean when they build up the property development over there, we can look forward to one-off gains from the property development sales from there. And this year itself, there's also a 344 key hotel upcoming, which they have partnered with RFS and Hilton. So they also have a stake in that. Yeah, so this is the kind of portfolio pipeline we can expect for WeHer. Next counter for Centurion. After they have spun off their REIT, we do see a stronger balance sheet. There's a 89% reduction in net debt. And for the upcoming AGM itself, shareholders can also expect about an estimated 7.5% yield from an expected dividend in specie distribution in the form of REIT units. So so this 7.5% yield is our estimates. And Centurion has also announced further portfolio pipeline visibility from 2027 and beyond. For example, they have a upcoming PBSA in Australia itself, which will increase Australia's student dorm bed capacity by about 60%. Yep. Next up for SoyBuild itself, they are main contractor in the private industrial space. For example, like the high-spec warehouses being built. So we do see an increasing demand for private industrial projects. For example, in October, there's a 39% year-on-year increase in contracts being awarded. We are positive on SoyBuild, even though we have a neutral recommendation because of the recent share price rally. We do think that that there will be increasing demand for private industrial projects because of Singapore's push to position Singapore as an advanced manufacturing hub. Next up for Evergory, they are a player in the M&E space, mechanical and engineering space, which means for example, your fire protection systems, your air conditioner cooling systems, as well as your electrical systems. Evergory has a significant order book of at least $312 million as of December 2024. We do think that this value is much higher today because we do think that they have won more contracts over the past year. And with the acquisition of Guthrie itself, which is another huge player in the M&E space, we do think that they can secure further project wins from upcoming Changi Airport Terminal 5, for example, the runway lights, as well as from upcoming hospital tenders, MBS IR expansion contracts. So these are the type of contracts that they can tender for, which previously they cannot tender because of their size. But after acquisition of Guthrie, they are able to tender for all these higher value contracts. So we are positive on Evergory, even though we have a neutral recommendation because of the recent share price rally. But we do think that they are able to secure future projects. Yeah. Next slide, please. Yeah. Next slide. So this is our electronics coverage. I think there's a question on what's our semiconductor coverage, and electronics coverage. So this is it. So firstly, Franken, they are a company which manufactures key components for semiconductor equipment companies. For example, their biggest customers are ASML and Applied Material. So for Franken itself, we do see an expected acceleration in wafer fab equipment spending in the second half of this year itself. So this is because we do see an increasing trend on foundry capex spending, for example, from TSMC, as well as Intel for the second half of this year itself. So we do think that will flow into semiconductor equipment's revenue, and then we do think that will benefit Franken as well. We do think that Frankel also has an attractive valuations of about 15 times PE, which is a major discount compared to the peers average of about 27 times PE. Yeah, next counter, Valuetronics, I'll present on behalf of Paul. Valuetronics growth is 6%, is considered quite lackluster, even though they have onboarded four big customers recently. And this is because they have exited some of their legacy consumer products, for example, electric toothbrush as well as shaver products. Southeast Asia remains an attractive sourcing venue for them. We do expect new customers from FY27 onwards. And Valuetronics is also trading at a cheap valuation of 12 times PE. And they also have 50% of their market cap in cash. So we have a accumulate call for Valuetronics. For venture, also presenting on behalf of Paul, we do expect challenging conditions till second half of this year itself. Because currently they are experiencing a change in the consumer lifestyle product. Because of this product design change, this has been hurting their earnings. However, the good thing about venture is that they have a high dividend yield of 5.5% and also a strong cash balance sheet of $1.2 billion. So we have a neutral call on venture because we do want to see earnings recover before we upgrade venture. Yeah, so that's all for my portion. I'll hand over the time now to Hashim. Thanks.
Thanks, Iqbal. I'll go through the air transport recommendation. So we have 4 stocks in our counter. First one is China Aviation Oil. So for those who are not familiar with the stock, they are the largest largest buyer and importer of jet fuel in APAC, and they also do trading of jet fuel and related products. Their 1H results increased 18% year on year. They have a monopoly position of being the exclusive importer of jet fuel into China. They have direct access to key airports in China, so Beijing, Shanghai Pudong, as well as Guangzhou. Going forward, we think there will be strong demand for their services. There is strong regulatory push. So in Singapore, we have a 1% mandate of using sustainable aviation fuel. And in Japan, we have a 10% mandate. And I think this will drive demand for China Aviation Oil. And apart from that, China Aviation Oil is also known to be having a large cash balance. So they have about $500 million in cash. And you might have seen the recent news. They are merging with Sinopec. And the thing with SOE-owned companies like China Aviation Oil, there has been a greater push by the Chinese government to increase their dividend payouts. So for China Aviation Oil, their payout currently is about 30%. And in the future, we see it increasing towards 50 to 60% range. And so we have a buy at $1.50. For SIA Engineering, we have accumulate at $4.14. So we saw their earnings jump 26% year on year. Their operating profit also surged to 274% for their latest results. And their largest customer is Singapore Airlines. So for Singapore Airlines, the story with them is that they have ordered a lot of flights, but most of the flights that they have ordered has not yet been delivered. So in total, they have about 50 flights that has been ordered in combination between Boeing and Airbus, and they have yet to be delivered. And as a result, their average fleet age has been increasing and been on an upward trend. So recently, it increased from 80 months to 87 months. And because of this, we think there will be continued demand for SIA engineering services. So going forward, we also think that the expansion costs related to SIA engineering's facilities in Malaysia and Cambodia will reduce, and we might see a margin improvement for FY26. For SIA, we have a neutral at $6.04. So they have a stable core operations, but the Air India associate, as we know, had a $300+ million loss, which has been a laggard to their bottom line. We think it will continue to be a laggard for the near term, and but SIA has introduced 10 cents per share special dividend, to sweeten the deal for investors. So our last counter in our air transport sector is SETS. We have a neutral at $4 and $3.84. They have won at least 20 global contracts for FY25, which has provided revenue visibility. And we think a potential catalyst might be the rollback of tariffs ahead of the midterm elections in 2026, which could be a boost to air cargo. So we kept it at a neutral because of the recent share price rally, and they're also slightly overvalued. Their PE multiple is 18x, but uh, their industry average is trending towards 14x. So with that, I'll pass on to Paul.
Yeah, thanks, Hashim. We just run through a couple of sectors in our views. Next slide. Yeah, okay. So for conglomerate recommendations for Keppel, we still have a buy. What we are expecting to drive the share price will be around 3 billion of divestments that they will look to do this year. Second, we think earnings growth is returning for Keppel. So the earnings growth I'm referring to is the new Keppel Sakra power plant from middle of this year. And there's two O&M contracts that will start to contribute to earnings from their waste to energy plants and also the submarine cable that's been completed. The third point we're just trying to say is that the longer term trajectory for them is they are building an operator fund manager franchise. And that is with a target of, I think, 100 billion or so of assets under management. And this will be a profit contributor and also to re-rate the whole stock because it will be asset light and fund management franchises typically have higher valuations. For Semcon Industries, we are a bit wary of the second half results that comes out in February because we think the earnings might disappoint or still be weak. But with the 5 billion acquisition that they did for Alinta Energy, which can drive earnings 30-40%. So this acquisition growth will help support earnings together with the Sonoco acquisitions that they did last year. The second driver to the share price we think will be like we mentioned earlier, they might probably going to list some of the renewable assets in India, which on book value is about 3 billion. The one holding back the stock which will impact the second half results is just the power spreads in Singapore. They had very strong power spreads. If you, let's say, you assume about 80 over plus dollars, and then now it's dropping down to about 30 or high 20s. So that is the one that's holding back the stock operationally. But we think these two share price drivers can help drive up earnings and also do some re-rating for the company. ST Engineering, we have a neutral. Obviously, this is not the right call. We were just too cautious. I think the valuations kept us sidetracked, and of course, we didn't know Trump going to take over Venezuela. But there is a reinforcement that the structural uplift in defense spending will continue, especially in this era of law of the jungle or law of the weapons, I guess. Then the second driver to earnings is like what was mentioned by Hashim. MRO demand continues to be strong. As planes get delayed, more and more maintenance. It's not just pure maintenance that you do. You actually have to uplift a bit of the work, and because you need the aircraft longer and they're older, so this will support them. And the third one is they sold the satellite business, which probably should have been the time to upgrade it, but we removed the loss-making satellite business, which will also support the earnings. Next slide. I'll move on to consumer. So consumer has been very weak the last 2 years, 2024, 2025 in terms of the share price. Especially the emerging markets. For Singapore, the Sheng Siong, we still have accumulated. Of course, it exceeded our target price. I mean, whenever we upgrade, it just exceeds it. Yeah. So, but the growth is still underway. Just at these valuations, almost 30 times historical, we're just a bit hesitant on the valuations. But they are growing stores 11% per annum. So you can just use this 11% as the type of earnings growth that they will get. But there won't be much operating leverage. Usually, if you grow sales 11, they normally get 12, 13 times. I mean, the growth on earnings will be higher because you got operating leverage, right? Because of all the fixed costs. But this time round, you won't see so much of that because there's wage pressure because of the progressive wage model. which will continue even into 2026. And they have a new distribution center, which you might start to see some costs start to creep up. So let's think of Sheng Siong as, of course, a very strong company and competitors are exiting, such as Giant, but the growth you're looking at maybe is low teens. For Thai Bev, of course, our call was wrong for this. We liked it. We had a buy mainly because we like the valuations, because they're trading at 12 times PE, and you're talking about almost a monopoly in the spirits business where they have 90%. But we think politics did hit the stock. The new government didn't have time to stimulate the consumer market. And of course, the Cambodia-Thailand conflict only worsened the situation. So Thai Bev is very strong in spirits business, and their low-end white spirits, the biggest customers are in the north, such as especially Cambodian migrants, which actually left the country and went back to Cambodia. But there is the bright spot is margins. So they did mention that almost all their raw material cost is coming down. So we may not see strong revenue, but we might see a sharp margin uplift. For Ceasing, I think no change. We still have a buy. The first half results is a bit softer than expected, but we do see growth in their process, growth in their seedlings, growth in their fresh. And of course, Hainan will be 5 times larger once they start to develop this project with CITIC Pacific. Next slide. So for healthcare, we are neutral. I think we are a bit concerned of the whole healthcare sector. Hospitals I'm referring to. There are 3 pressure points for the hospitals. There's foreign competition, of course. This is not a new theme. Since the pandemic was over, the hospitals here are starting to feel it, I think, especially for Malaysia and so forth. The second pressure point is insurance. So they are getting pushback on the high prices from the insurance company. We saw that with Mount Elizabeth, with Great Eastern not allowing pre-approvals for Mount Elizabeth. And the third pressure point is, of course, public hospitals. So public hospitals are ramping up capacity. We are getting 2 new hospitals by 2030. Capacity is probably going to go up by public hospital about 30 to 40% by 2030 and more, because depending on the timing, because a lot of hospitals are also expanding. So for going back to Raffles Medical, the one positive for them is their insurance is turning around more into profit. And China, they said they can break even by this year, if not next year, EBITDA-wise. But we just need to watch, because China is a very complex market. Patients prefer to go to the government large hospitals, so it will take time for them to get more and more specialists to practice in their hospitals in China. For Q&M, we still have a buy. This is purely, we think, an M&A story in the very near term. They are starting to acquire more dental, so they could double, triple their earnings by this acquisition rather than this slow, maybe high single-digit kind of growth organically. We've seen one of it, at least at the MOU stage, the Thai hospitals. The one difference, Q&M Dental's roots has been on mergers and acquisitions. So one thing they're doing differently with the Thai deal is that around 40% of the compensation is tied up for 15 years. So basically all right together on this platform. Organically, the chest, I think you saw a bit on the press that the elderly are not getting enough dental care. And I think the government has been supporting by raising the subsidies for chest and so forth. So they are getting better volumes. We think that the chest that's rolled out since October. They also continue to realign the Singapore cost. The one on the side is the AI upside. So, they have a 1,000 dental chain clinic deal. That will take time, but essentially this AI upside, which I think nobody prices in because it's not unprofitable, where they will use this AI or this software to give the suggested or recommended procedure. And if they do this roll-up strategy, this AI upside can grow also. They can actually roll up this AI, maybe into the Thai dental clinics and so forth. Thomson Medical, we still have a buy. Operationally, they are pivoting more to oncology or cancer care or cancer treatment into Singapore and also Malaysia. The overhang in in Malaysia, the KL hospital, where 1 or 2 hospitals exited or did what they did to Mount Elizabeth, where you need no pre-approvals, which is of course dangerous for a patient. And you go in, unsure you can get reimbursed. That overhang is slowly eased. And of course, the key thing to watch this year is monetization of the Johor Land Bank. With the RTS coming in by end December, I think they are still working out their strategic options, like who to partner with. Hyphens Pharma, we think the earnings might be soft in the near term because Vietnam is facing weakness, especially in the currency front. So we think the conditions there are still challenging. But longer term, medium term, you saw last week they did the first time ever they're starting to sell or get sales of Ceradan or distribution for their Ceradan. It's called a different name, sorry, I just slipped my mind, but it's starting to happen in Europe. So that's a game changer. But don't expect any contribution in the very near term. It's probably more 2027. But it's a re-rating event because you're starting to sell their Ceradan into Europe with a distribution agreement. Next slide. Okay, so for telcos, we still like Singtel with Accumulate. There are three reasons why we like it. We think there's earnings growth will remain strong. I think in the first half results, their underlying earnings was up about, I think 14%, if I'm not mistaken, or 12 or 14%. The mobile, so what's helping is the mobile price. So mobile prices is starting to creep up or rise, especially in India, of course. Second is in Thailand because the industry there has consolidated. And of course, also in India. Australia has also starting to raise prices. So that will help the earnings. The second thing is the monetization that we mentioned earlier. And the third thing is another driver to earnings is their new data center in Tuas, the 62 megawatt, which should start to operate in the middle of this year. So all this will, you get the earnings growth and also monetization. For StarHub, we have neutral. We think competition remains intense. So competition has now translated to unlimited price and data plans. So it's continued to intensify, and I think our view is that a post-merger StarHub will become the smallest, and obviously based on their price moves, they're not happy with it. They're trying to get share before the merger is concluded. So basically a price war is happening. But one thing that could help the share price is the Ensign deal, which we are not sure what is the amount, but they do have a deal with StarHub whereby Temasek, they can sell back Ensign to Temasek with a certain gain on it. Netlink, I think, is very stable for the next couple of years. So Netlink's base earnings is the 1.5 million customers. People like us that have broadband. They pay 13.50 to the telcos and the telcos pay them. So it's a very safe stock. I mean, the yield was 5.5 and this will continue, I think, because it's basically a monopoly on fiber connections. For last one, TeleChoice, we still have a buy. The growth will still be healthy as they are riding on U Mobile. So U Mobile is like the fourth operator in Malaysia. They just got the 5G license. So they're ramping up their distribution network, ramping up their subscribers. And the other driver for TeleChoice is we think they will start to venture more into data center projects. Next slide. Okay, just on a model portfolio. So the only change we did is we took out OCBC and replaced for Escort because we think maybe the quality of dividends from the banks will be better. And you kind of hedge out if interest rates do rebound for whatever reason, of course the banks will benefit. So you kind of hedge out and lock in some of your interest, your dividend about 5%. So we preferred the quality of the yield for the banks rather than the REITs. We also took out CapitaLand. That has been a very disappointing one for us. Although China re-rated, but it didn't happen to CapitaLand investments. So we added in Franken. I think Iban kind of mentioned it. And we haven't done many initiations, I think, for this SSP, but you should expect a lot of initiations coming out in the next SSP. Next. This is an illustration of our model portfolio performance. It was up about around 40.7% in 2025. This is just illustration. So what did well for us was, of course, ST Engineering that we had in the beginning of the year. Then other things that did well for us was Propnex, Keppel, across the board, some small mid-cap stocks, Keppel, Singtel. I can't remember every single one, but these were the ones that helped drive up the returns. Next slide. I won't do the conclusion, but anyway, we think it's a fertile environment. There's investment teams, and I think we can move on to Q&A. I think there's 60 old questions. Yeah, I think let's move on to that. Thanks.
Yeah, maybe let me just start first. Yeah, so someone's asking, about the UOB, whether it's value buy or better to avoid entirely. Yeah, I would say it's we didn't pick it, because of the reasons. They haven't really settled their provisioning, although they did say so. So that's the main thing. And also the other thing that I forgot to maybe mention earlier was that their fee income growth is very weak. Right? That's the only one of the biggest buffers, for the lower net interest income is fee income, wealth management income. Right? And their fee income, it even declined by I think 1% in the last quarter. And the reasons is because their customers are very prudent. They rather just park it into a fixed deposit with 1% interest than to place it into maybe a riskier investment. So that's the main reason that they gave. And also, their acquisitions in for the city assets have not really been paying off yet. So once that kicks in, then maybe we can see some runway for it to grow. Yeah, but for now, I would say we have a neutral call, and so it's best to avoid it first. Yeah, some questions on the US banks. Hold on, let me just go through. I'll just put it all together. The banking questions from the US. So it's basically just asking what are the expectations of the earnings and outlook also for the first for 2026, with more Fed cuts and also the impact from the big beautiful bill. Yeah, so it's quite bullish, it's quite positive for the US banks, mainly due to the big beautiful bill actually helping to lower regulations. And also the rate cuts do present some sort of headwind. There's a little bit of headwind for margins, but then it will help to offset in terms of their funding costs, right? Deposit costs, competition is very high in the US. So when this comes in, when rates go lower, it will be almost an immediate benefit for the US banks in terms of their funding costs. And also the steepening of the yield curve is also actually very helpful to offset some of the margin declines. In terms of the banks that we cover, for JP Morgan, the focus will be a lot on their IB fees, right? But their share price is at an all-time high, right? So how much the IB fees grow and whether or not they can offset a lot of that from the margins will help to sort of justify the premium that they have, being I guess, the largest bank in the US and in the world, I guess. Yeah. So for Bank of America, it's really a lot from their operating leverage. Their deposit franchise is one of the biggest in the US, and it will sort of stabilize, we believe, because of the rate cuts. So they benefit the most from the savings, from funding costs, right? So they are the ones that will benefit the most from that. So we believe that the growth will come mainly from their net interest income. And lastly, for Wells Fargo, it's a lot of the asset cap talk, right? They lifted the asset cap, so they are able to grow a lot faster in terms of their loan book, in terms of their deposits. So they can grow a lot faster. So that will be the main differentiator for Wells Fargo. As for the other banks which you don't cover, Citigroup, it's a bit of still a restructuring story, so I don't think earnings will perform that well. For Goldman Sachs, similar to JP Morgan, it's a lot of high expectations on their investment banking revenue. Yeah, we have one more question on, I think, let me try to find it, but from what I remember, it was Trump announcing a proposal for a 10% interest rate cap for credit cards in the US, right? So this is actually quite, I think it's a very, maybe its midterms are coming soon. So it's a very populist kind of proposal, right? To garner a lot of the support from the everyday person. But then again, it sort of, it sort of contradicts the big beautiful bill where it aims to deregulate the the banks, right? So this is just a regulation to ensure that they can lower their interest rates. And also the main thing to look at it is that this cannot just be passed with one of his usual what do you call it, the executive orders, right? This has to go through the Congress in order to get approved. He can't just sign a piece of paper and then approve it. Yeah, but the main banks that we see that will get impacted by this will be Citigroup, because they have a very, very big card segment, and a few of the other banks which we don't cover, like I think Capital One is one of the biggest ones. So they are the Capital One and Discover. They recently did merge, so that is the biggest credit card, I think, company that will get affected in the US, because they really focus a lot on cards. Yeah. Apart from that, it's still, I think he cannot get this passed immediately, so it'll be quite hard for him to get it passed. But margins will definitely get fee income margins, in terms of card section will get slashed. We'll see a lot of the banks remove a lot of the rewards, maybe the sign-on bonus or the card waiver, all those things will get removed immediately overnight if this gets passed. Yeah, so we'll probably see quite a bit of a decline in demand for credit cards if this gets slashed. Although, you see that the interest rate is lowered. So the banks will have to make it up some way or the other. Yeah. So in the end, I don't think there's much benefit for the end consumer, because you just end up paying more fees. You have less rewards. Yeah. So that's all for. Yeah, okay. One more here. Sorry. Is it already late in the game going to DBS or OCBC now? Yeah. For DBS, and OCBC, we believe, it's before they announce anything, right? It's still okay because they haven't announced any capital return plans. That's what our play on OCBC is that there's a lot of surprise into capital returns, right? They are keeping the news, they're keeping it very close to chest, because the handover of the CEO and everything. So I don't think they wanted Helen to announce anything, or she didn't want to announce anything. They will be giving it probably to the new CEO. So is that bad that they will be giving back capital or continuing to give back their excess capital in the following years? As for DBS, even with their current price now, we're still looking at FY26 dividend yield of 5.9% and FY27 of 6.1%. So yeah, so basically, yeah, that's it. So I don't think it's that late in the game to go into either one. Yeah, I think that's all for me. I'll hand it over to the rest of my colleagues. Thanks.
Questions. Sorry, there's a lot of questions. Philip's covered Evergory earlier, but that has not maintained any update. Will there be an update soon? Yeah, so because Evergory only publish half-yearly results, so I think we can look forward to an update after their full year results probably in February. Yeah, but I think the update for Evergory is that we do think their order book is much higher, because we think they have won more contracts from, for example, hospital tenders has been tendering out. One example would be Alexandra Hospital. I think one contract size can be up to 200 plus million. So I think those are the kind of scale of contracts we can look forward to from Everglory. But they haven't announced their updated order book, so also can't disclose much also. Yeah. Any takeaways from CES for NVIDIA, AMD, Intel? Yeah, thanks for the question. Last week they had the CES. I think the main takeaway is that the entire demand for AI is still strong. I think NVIDIA has been saying the next phase of growth will be physical AI. Currently, we are in the phase of agentic AI, whereby inference demand is very high. So the next phase will be physical AI, whereby they will use humanoid robots in factories, and maybe like everyone will have a physical robot assistants in their homes. For example, they can help you scan your sketch a room layout. They can generate you can use voice activated commands to ask them to do things for you. Yeah, so those are the kind of demand we can look forward to. Nvidia has mentioned that Vera Rubin is in full production. It's expected to come out in the second half of this year. AMD as well, their next generation GPU coming up uh by year end this year. AMD even further announced that the next generation, which is the MI500X GPU, is on track for 2027 itself. So they have, I think in terms of outlook, AMD has provided a clearer outlook compared to Nvidia. Yeah, so that's the overall takeaway. Thanks. For Intel, they have announced future, a broader product range which they are trying to take PC market share back from AMD, but we do think that will still need time before because AMD's PC products is still very strong. It's still taking market share from Intel. Yeah. Yeah. So there's a question: views on Singapore semiconductor sector, say Franken, Aztec Global, and their respective target price. Oh yeah, I think that's just now I addressed that in the slides itself. We only cover Franken out of the semiconductor peers. Aztec Global, I think they are still restructuring because the demand. I think one of their major customer has changed their product, uh so they are still trying to look for more clients to replace this loss in demand. Yeah. Any thoughts on micromechanics outlook going forward? Further upsides. Um, I think one potential catalyst is that micromechanics has quite a lot of is quite heavily based in the US as well. They have a factory over there, and they mentioned they have recently onboarded a front end customer from there. Historically, they were mainly focused on the back end side, so that may be a potential catalyst. But in the most recent earnings, the front end performance hasn't been is quite lackluster lah. So we do need to see more performance from the front end side before um confirming the front end onboarding will drive meaningful growth for them. Yeah. Uh, how's the valuations of memory storage stocks after rallying so much? The likes of Micron, SanDisk, Seagate, Western Digital. Yeah. So for Micron, I think the forward PE is high tens. Is about 16 to 18 for Micron. For SanDisk and Seagate, I'm not very sure, but I think it's about 20 plus to 30. Yeah. So that's in terms of the PE ratio. But the valuations may, how to say, the sentiments for memory stocks may change quite abruptly, especially as we know now is the phase of shortage, whereby um the price increase for DRAM as well as high bandwidth memory has spiked. That's why analysts are valuing memory stocks at a higher valuations PE. But once this shortage is being fulfilled, um, once the price of the DRAM and high bandwidth memory drops, right, the valuations may change, the sentiments may change quite quickly, lah. So that's the risk for the memory storage stocks. Yeah. Uh, thoughts on Centurion vis-a-vis Centurion, which is a better buy in terms of valuation and dividend yield. Uh, I think in terms of valuations, PE ratio wise, Centurion may be a better buy because forward PE ratio wise, Centurion is about 12 to 13 times. Centurion REIT, I think, is close to 20. Yeah. But in terms of dividend yield, Centurion REIT is expected to give a much stable and higher dividend yield as compared to Centurion, because I think ultimately it's a REIT, and I think they have committed to about 7% dividend yield, if I remember correctly. Yeah, so that is higher than Centurion. Yeah. Uh, we heard break 80 cents anymore upside near term. I think that one we can leave it for Zane to conduct the TA, but I think fundamentally, yeah, uh, the supporting I think the factors that are supporting the share price is the portfolio product lineup going forward. I mean portfolio roadmap going ahead. So they have the GLS site upcoming, they have the hotel upcoming, they are also building the PBSA as well. And also they are aiming for a development application approval by the first half of this year in Australia itself to expand their property development. So those are the kind of um, fundamentals which continues to support their share price. Yeah, and also they have a very strong recurring streams of growth from the construction and worker dorm sector, which I mentioned earlier. Yeah. Does Philips cover UMS price? Sorry, the question jumped. Yeah. Sorry. So I cannot find the question anymore. Sorry about this. Does Philips cover UMS price decline last week? Any thoughts? Any reasons and thoughts? Equally, any thoughts on AEM since Intel fortunes is reversing? Yeah, actually, just to clarify, UMS, I think you may have seen the price decline is because they issued some bonus share. So theoretically, they issued one share for every four shares. So theoretically, the price should drop by about 20%. Yeah. Any thoughts on AEM since Intel's fortune is reversing? Uh, I think yeah. I think because of the currently the turnaround phase of Intel, it may have a positive impact on AEM. Yeah, and I think AEM's new customer, we do believe that it is in the front end semiconductor space. That one is driving quite a lot of growth for them. Uh, so we do think that AEM has quite a lot of growth drivers going forward, but currently it's still on the expensive end. I think the forward P is about 60 to 70 times. Yeah, so that's one thing to take note for AEM. Yeah. Is Centurion accommodation REIT better than Centurion? I think it depends on your investment objective. Centurion accommodation REIT, I would say is more targeted for dividend yield investors. For Centurion, it's more of a future prospects growth kind of stock. Because the management, even though they have spun off the REIT, the management is still in place for Centurion itself. So management has a very good track record of spotting growth areas very, very early on. For example, their venture into UK student accommodations as well as Australia student accommodations. So that's the appeal for Centurion compared to Centurion Commerce REIT. Yeah. Any views on AM? Yeah, so I think I mentioned that already. But why you drop AEM and UMS in your buy list? What is your view on global testing? Yeah, just to clarify, we did not cover UMS and AEM in the first place. This year we have only, I mean last year we have only initiated coverage on Franken. So yeah, we don't cover AEM and UMS. Uh, as our view for global testing, we are not very sure with the stock because I mean just doing a quick check, I can see that it's in the back end space. It's doing testing and packaging. Uh, and I think that because of the increasing demand for front end semiconductor space with the use of wafer fab equipment, naturally the demand will flow to the back end testing and packaging. So industry perspective wise, this will benefit global testing. But sorry, can't really give you much color on that because uh we don't really have close contact with the management for this. Yeah. Yes. I think I hand over to my other colleagues first. Thanks.
Thank you, Iqbal. I guess I'll take some of the questions. Why Apple dropped so much recently? Is it a bargain now? I think Apple, all in all, compared to the other big tech companies, it is simply not growing enough. Their revenue growth has been single digit for the longest time, while their peers are all growing like double digit constantly boosted by a lot of the cloud and AI, which seems to be the main topic now. So in terms of AI, Apple is really very behind in the game. They simply do not have anything concrete to compete with others, not to mention that the others they're still running forward with full speed. So they're still doubling down with their capex spending. And this is not to even look at the hyperscalers, just to compete them with the other mobile phone competitors like the recent features that came out from Apple were translating and image editing. So all these features already a long time ago came up with from their competitors like Huawei and Samsung. So previously Apple was considered the premium brand, and the other competitors are cheaper but work just as well. So that is the selling point of the other competitors. But now when the other competitors they're coming up with better features, it's simply very hard for Apple to compete with them. So fundamentally, it has been lacking, and with such little growth, they have a PE ratio of around 30, so that is really hard to justify. But if we really look at their latest earning, it was actually pretty promising. iPhone 17 was doing better than expected because the latest strong growth of their iPhone was actually in 2021, so that is 4 years ago. Then later the growth become very low single digit. So 4 years, if you think about it, it's right about the time where people want to consider upgrading their old phones to new phones. And iPhone 17 happened to pack a lot of new features. They're not revolutionary, but they're good enough. And pricing wise, because it's very similar pricing to iPhone 16, and their storage was the lowest price model, the storage was twice as much. So if you really think about it, all these kind of prompt people to buy it. And their next quarter outlook is also very positive because their previous quarter there was over demand, so they cannot really keep up with the extra demand, and they're going to deliver those in the next quarter. But all these are just noises because they still haven't come up with a lot of revolutionary AI features. So they do have this Apple Intelligence, which is they're basically integrating the AI throughout the entire phone ecosystem. So that is actually when it first came out, we thought it's a very smart approach because it's not competing head on with the other hyperscalers in AI, but it's definitely a new angle to entirely change the way people use their phones. So this is something that was building a lot of expectation. But after that, there wasn't much big splash because the biggest feature, the Smart Siri, they're supposed to roll it out in 2025. It got delayed and it's only going to come out in the beginning of 2026. So far, we haven't seen any news on it yet. So I would say we're still pretty cautious on Apple. Our current recommendation is still reduced, and our target price is 230. So even when the price came down, it's still above our target price. So I hope that gives you a little bit of color. Sorry, there's too many questions. I'm trying to flip through. Is Grab a good buy after it launched its food delivery pilot? So for those who don't know what the food delivery pilot is, so they've recently started a 3 month trial of drone food delivery, which is in partnership with ST Engineering. So what they basically do is they're exploring how you can use drone to improve delivery efficiency. So it's not entirely delivered by drone. It's the riders still have to pick up the order, and they're gonna send it to a drone launch pad. So then there's going to be a Grab staff that launches the food onto the drone and send it across to another point. And the point, there's going to be another staff that takes the food down and give it to another rider. So they're going to finish it and deliver it to the customer. So right now it's still in very experimental stage. The reason they do it is they try to see whether they can improve efficiency, because sometimes you gotta across the river, or sometimes there's certain area that has very complicated roading. So they're thinking maybe this can improve the efficiency. But right now it's still experimental stage, so it's more of an experiment than an immediate profit driver. But Grab in total, we like it because they're doing everything right as a mega app. Right now, I think they're driving is segmentation of their customers. So they're coming up with a lot of high tier or like low value different promos to cater to different customers. And also because they are a whole ecosystem, so they're trying to do a lot of things that drives the synergy across the ecosystem through membership and referral between services. Their finance services is also scaling very rapidly thanks to their very strong ecosystem data. And because of the data, they're going to be able to know how to underwrite underbanked users. And at the same time, they're also putting a lot of effort in their advertising. And because advertising is a very high margin business for them. So now they're trying to push the merchants to adopt it more through the food delivery and Grabmart. So all these are pretty positive. We still have a buy recommendation for Grab. Our target price is $7. I think there's another question on Netflix. about the merger. I can't find. Sorry, there are too many questions. Oh yeah, what is the current situation? Sorry, Flip. What's the current situation on the Netflix Warner Brother deal? Is the buy now after the share price came down so much? So the deal was, for those who don't know, Netflix agreed in December last year to acquire the Warner Brother studio and their streaming asset. They came up with a proposal of I think 83 billion US dollar. So this will include all the HBO Max and DC studios and all the major franchise content. So right now the deal hasn't went through. It's still pending regulatory approvals and processes. But we would say the deal is currently the preferred path for Warner Brothers because Warner Brothers, they actually rejected a rival that's a higher bid from Paramount of 108 billion US dollars. So they kind of reaffirmed their support for the Netflix arrangement. So if the deal were to go through, then Netflix would move from being primarily a distribution and original company to a vertically integrated studio platform with decades of a lot of the evergreen IPs. So this would definitely narrow the IP gap with Disney materially. So Disney will still be the one that holds the most number of IPs. But Netflix right now, they're already dominating the screen-based monetization. So if they have a lot of IP coming in, that would definitely help them to dominate even more. But if you really compete with Disney, they were still leading due to they have the experiences, which is their Disney parks and the merchandises. But what essentially it means for Netflix is it's going to have a stronger pricing power, and they're going to be able to have a higher ARPU because with the extra content that coming in, they're going to be able to raise their price more confidently, and they're going to be able to persuade more users to subscribe into their premium tiers. And even for their advertising tiers, they're going to be able to attract more people coming in because right now they're ambitiously trying to expand their advertising. So overall, it's gonna be a better lifetime value per subscriber, if I can say. So for the long-term growth. And in terms of margin wise, within the long term, it's definitely a good thing because they have less reliance on expensive third-party licensing, so they can have better amortization leverage on their own IPs. So that's definitely going to help them in the long term in terms of margin. But in the short term, it's definitely going to be a risk because they have higher debt and the integration cost between the two companies is going to be very high. The Warner Brothers, historically, they have pretty weaker margin drag and near-term profitability. So all these are going to be weighing. So I guess that is why the share price has been going down because first, the deal size and the debt burden. So it's definitely something that investors are concerned about. And also there's the strategic risk because it's essentially two very giant entertainment business. So in order to integrate them together, it's going to be complex. And third, there's still a lot of regulatory uncertainties. So Netflix is actually going to release their earnings next week. So by then we're going to be issuing a report, and I hope by then the management can provide us with more colors. I guess that's all from me for now. I'll pass my time to my colleagues first. Thank you.
Darren?
Yeah, let me try to answer some. So the first one is CDL and ULL have been rising lately. Any more upside? Yeah, so we expect the momentum for the asset divestment to continue for both companies, and also the residential sales were extremely good for these two. Like CDL and UL both had very strong. Like UL had Sky at Holland, so that was over 90%. CDL Zion Grand as well as the Ori. So all these are over 80% sold at launch. So we think the momentum will continue. Okay, so we still think there is more upside for these two companies. Yes, I think it's lagging. Let me. Sorry, that's very question. Let me just flip Steam. Ooh. Yeah, will not both Stonework and Premier Street, are they not potential dividend value traps? Yeah, so I definitely do not think so. So normally potential dividend yield traps, will mean like high yield, but the underlying performance is not doing well. So which is why the share price really corrected, and as a result, they're paying very high dividend yield, mainly because of the fact that the share price is down and the dividend kind of stable. But that's all we think, because operational wise, both Stonework and Prime, Stonework has been very resilient. So the occupancy over 93%, and we expect it to continue. Positive rent reversions also expected, like more than 5% for their whole portfolio over the next few years, and coupled with lower interest costs. So we expect dividend yield to actually increase. So not so much dividend yield trap. And in fact, the share price also been rallying. They've been buying back shares and also cancelling shares, so that will help to support the DPU as well. So for Stonework, definitely not a value trap. For Premier Street, their operations are improving. So going forward, we expect a higher payout ratio, as well as there is a lot of income visibility from Premier Street's portfolio as they sign longer term leases, and because of the very long rent-free period as well. Like usually they sign like 10 over years of leases, like the large leases, and that comes with tenant incentives of about like 1 year rent-free period. So as they sign it over the past year, the income actually has not really come in yet. So once that comes in, so it's basically the DI distributor income will increase, will jump. Right now, only about 70% contributing cash, 70% of occupancy from their portfolios contributing cash. So that will jump, and as a result, the yield will also increase. So basically, I do not think these two REITs are potential dividend value traps. Yeah, Premier Street is being traded in USD. Have your buy recommendation taken into account for the potential weakening USD SGD? Yeah, so actually, I didn't really account for that, because after all, our target price is also based on USD. But you are right that if the USD weakens against SGD, your returns might be slightly affected by the depreciation of the USD against the Sing. Yeah, but my target price is in USD, so yeah, you have to account for the translation the effects. But generally, we expect the improving distributions or higher dividends to kind of offset any weakening in the USD that is expected. Yeah, so still a plus. Any coverage on Global Land prices seems low. Yeah, so Global, I think the question jumped. Okay. Yeah, so for Global Land, we don't cover. Well, so let me try to find a question. Oh yeah, price seems low. Their sales record is very strong, and for a few CCR and OSAT, yeah, you're right that their record very strong, like Penn Reef as well as the other Faber Residence, both also over 80%. So going forward, we expect basically very strong performance as well for them. Like all the property companies like Gokuland, CDLC, UL, they are benefiting from the resilient property demand. You can kind of say last year was a little bit of pent-up demand from like interest rates are so high, then suddenly it fell so much. So there will be a pent-up demand from there as well. Yeah, and also the launches a lot of them were at very, very prime locations, like near schools as well. So all that helped to benefit the performance. So going forward, we expect the momentum to continue. So that will also benefit Gokuland as well. Yeah, please update on Suntec REIT acquisition status by the Tanks. Yeah, so most recently last year, the Tanks, they acquired the manager. So that was for about 190 million. So we think Suntec REIT this year, there might be some significant changes possibly because of the basically the new manager. So now they are aligned with the Tanks. So the Tanks now they currently own also about 35% of the REIT. So in my view, I think it is very likely that they might launch another privatization offer. So that has to be 1 year after the one that didn't go through last year. So yeah, there might be some some potential acquisition or privatization for Suntec in my view also, yeah. Or rather, if they don't go through this path, they might make some significant changes in Suntec REIT, like the way they operate, perhaps expand further into other geographies or yeah. So potentially Suntec REIT, there might be some big changes coming, yeah, in my view. Yeah, so that's the latest update. I think there are a couple of other questions that I'll type it in. I'll leave the remaining time to some my colleagues. Yeah, thanks.
Yeah, thanks, Darren. Yeah, anyway, anyway, I'm going to answer. Okay, hi, Paul. Yang shipping is rising while Yang maritime is dropping. Do you have any insights from there? Yeah, so for me, at least, I'm a bit more cautious on Yang shipping because the whole container boom is consolidating. I mean, there's like huge amount of orders, like 30% of the existing fleet on order. So I'm a bit more cautious on Yang shipping. For Yang Marine, I'm more positive on Marine because if you look at their numbers, I mean, most of the earnings they're doing now is from interest income, and they're doing this big shift, focusing more on lending into lending into the whole shipping industry, either vessels during the completion of the vessels or even during the pre-building. And this is, shipping is their DNA, and that's where they have the best insights. So for me, amongst the three, Yangtze Marine is I'm most positive on. For financial, I'm a bit more cautious because they got like 40% NPL, and I don't think the China book is improving. So I'm a bit more wary on Yangtze Financial. That's my own thoughts, although we don't have coverage for now. So for CNMC, okay, CNMC. So the question is, why CNMC share price lose correlation with the gold price lately? Is it because of overhang of the tax issue? So the tax issue is about 29 million ringgit. We don't think that is the big overhang. I think it's just that firstly the share price has gone up a lot, and also gold price hasn't been like skyrocketing. And just to do a refresh, why did we cover CNMC? So CNMC, like all gold miners, not to teach anyone about gold investing, but they are a very lavish way to play gold price. You get that leverage because CNMC's production is jumping, I think at least 30-40%. So long as that continues into 2026, we will still like the stock. And the leverage you are getting is that, a 10% move on gold price, it's like, I don't know, 2-3 times that when you get it on the earnings of CSMC. So you're getting that big leverage. So even though gold price might move up 5%, the earnings will skyrocket will double that amount in terms of percentage wise for CNNC. And on top of that, you're getting the production growth. So we still like CMCs because we still think there's production growth as we move into 2026. The tax issue, of course, is small in the near term, but of course, it does makes you worry. You are still operating in an emerging country like Malaysia, and if the profit continues to rise, I mean, there will be temptation. That's all we can say. But so there is a longer term issue with it. I think the local politics is always the first thing we ask them when we meet them. Yeah, but for now, we are still positive on CNMC. Hi, Paul. On healthcare, you show a chart of private versus public hospital admissions. Is the drop in private admissions due to medical tourism or local private patients cannibalized? I think it's a combination of both. If you look at IHH, IHH, which owns Parkway, Gleneagles, Mount E, their volumes are down about 10%. We think a lot of patients are also moving, or at least nudged by the insurance company to go into the public sector. But there is a bit of nuance, not to go into ultra detail here. A lot of the private hospitals these days are also pushing for day surgery or ambulatory care. This will keep costs down and improve the utilization of the facilities. I can't give you a quantity, how much of that 10% actually is because of the move towards day surgery and so forth. But volumes is still getting hit like you said, they're being squeezed at the bottom. You're squeezed by public hospitals, and then the higher end procedures, people also moving to Malaysia and even Thailand. So that is the challenge for private healthcare or private hospitals. Any opinions on housing and IX? I think there was some news of Goldman Sachs doing some comments on housing. I'm not sure why, but housing is something to watch. I'm not sure if they will become a platform for M&E. Maybe it could be a platform to do M&E for our China assets, which I'm not sure, because right now Q&M can also do that, so I do not know. For IX Biopharma, as you know, we've been monitoring this company since 2019. So if you look at the recent slides that they did in their AGM, there was a peculiar comment. They mentioned, if I'm not mistaken, they're working on something with a US government agency. So I think for IX Biopharma, all the moves that they're doing now, if you look at the slides, is they're trying to commercialize what they have, the IP they have, which is the wafermin, the whole waferix technology. So they're doing it through a manufacturing plant in the US, which they don't actually have to pay for it. Someone is willing to fund, because I don't think the funding is much, willing to build a factory for them so that they can sell their products into the US. And of course, they will take a share of the profit, manufacturing profit, but most importantly, get access to their products in the US. So we'll be beginning to see more commercialization, and do note that if you look at the accumulated losses of this company, it's about 100 million. So in a way, they spent 100 million to develop this product, which is the waferix technology, which is basically to put the drug under your tongue. And only now, after so many years, we're beginning to see some commercialization. So I think you should look at the slides that they did in the AGM. I think that's the only thing they announced. Yeah. Paul Propnex can comment on the outlook the next 12 months. Yeah, okay. So we upgraded Propnex, I don't know, 3-4 times since the share price was 80 cents. So right now, we held it back because of valuations again. So for us, rightly or wrongly, we do have a bit of hesitancy when the valuations hit 25-30 times. But the outlook will still be strong, or at least can maintain, most importantly. Because like what Darren mentioned, there's at least 9,000 units to be launched this year. And more importantly, about 65% of these launches are in OCR. And OCR is easier to sell. I mean, it's not so expensive. So you should get another very strong year. The growth won't be as good as last year in terms of percentage, but you should still get at least 9,000. And the key for me to watch is the resale market. So if resale can cover the weakness, because resale was a bit flattish or slightly down last year, more like flattish. So if that can recover, that can at least keep the earnings strong for this year. So 2026 earnings will still be very strong because their second half, all the units that you sold second half, or maybe in the fourth quarter, the strong performance will only translate in 2026. So they will still have another good year ahead and pay good dividends. But of course, you don't expect the kind of growth like they had. Because last year, new launch was up about 150-160%. Maybe this year, high single digit or low teens. But resale is what we're looking for. But more importantly, we don't think there'll be government intervention. I think the government's focus now is to raise supply. That's why GLS is very strong. Government land sales, confirmed government land sales strong. I think they're going to use that to contain prices rather than cooling measure all the time. So don't really cool much also anyway. So that's my own view. Yeah. Is your AI investment cater? Oh yeah. So when we meant CapEx, AI investments means that you get earnings growth by building a data center or AI data center. So this will come from your Keppel Limited and also from your Singtel. For Keppel, it's a bit more unique because they will get earnings when it's constructed. They get earnings from funding it, from raising funds, and so forth, because they have a private fund business to fund all these acquisitions. CSE Global has moved a lot. Is it buy entry? Although we don't cover it, I think there could still be upside in this stock because the ramp in data centers has not peaked in the US. And who knows if Amazon come in, you won't be surprised if maybe Google also take a stake or Microsoft might even want to take a stake. I do not know. I'm just 99% speculating here. But for Amazon to buy a stake, obviously they are buying it. Of course, there are probably some gains that they get, but more importantly, they want to lock in the supply. There's a bit of shortage in the ability to supply power, as we all know. So I think CSE still has upside, and the order books are starting to show it. And they're also getting orders in LNG, which is a bit of a surprise. Um, okay. Hi, Paul. Do you have a target for STI? So you notice we never put a STI target, mainly because STI almost wanted to fine us, the FTSE, because we use STI without license. So we don't mention them in any of our reports, even in our charts, because of licensing reasons. Although we pay for it, but we just don't want to get fined and them coming back to us. But if you look just mathematically, if the STI were to hit the upper end, you're talking about maybe 10% gain from here. Because right now the STI is getting about 15 times PE right now. If you push it to upper end, the one standard deviation, maybe 17 times, you're talking about maybe 10-12%. So there is still upside. And to be blunt about it, I'm more worried about 2027. So for this year, it's easy to call a buy on the Singapore market because the valuations are still attractive. You still get a 5% yield. 2027 is going to be tricky because at that time, I can't sell you on fundamentals. At the time, I have to sell you on stories. Yeah. So for 2027 strategy, don't be surprised. I'll just be selling you stories. Yeah. Because the time the valuations will be expensive, then have to sell you on pie in the sky and stories to get people excited. What's your thoughts on the IPO assembly place? That one I'll leave it to Yikban. But I think, okay, let me answer this last one because I think we'll move on to some TA. Paul, a recent Business Times article, China Polar Silk Road opening up the Arctic routes and shortening Asia-Europe voyage. Please comment implications. I think still a little bit of a pie in the sky for me. I'm not an expert on Arctic, never been there obviously, but to go through the Arctic, it's only feasible during summer months. So you can only use it during that 3 months or 4 months of the year. And the second thing is that the route is going through Russia, through Russia. So I'm not sure which European country wants their ships to go through Russia. If you look at the current animosity between Western Europe and Asia, I don't think any vessel owner were there to use, instead of going through Singapore and more friendlier countries, you want to ship to China through Russia. So that's my only pushback I have. Yeah. Your target price for Pacific Reason still valid? Yeah, it's a bit higher now. Yeah, I think we also get that question for China Aviation. So we are just putting it out there. This was our last recommendation. We won't update. We just want to let everyone know these are all above our target price, and we will do an update when the results are out now. So of course it's a bit nonsensical to put a buy when it's already below, but these stocks are up already 30-40% when we put our target price. So just bear with us. I think we will need to get an update when the results are out and so forth. Yeah. So apologize. Not every target price has been updated recently. Yeah. I hand it over to you. Sorry, there's still lots of questions. I think like 50, but I hand it over to you, Zain, to take some TA first.
Okay, thanks, Paul. Yeah, I see there's also a lot of questions for the TA. I think unfortunately I won't be able to cover all of them, but there's a TA webinar tonight at 8 to 9:15. So if any questions, feel free to dial in and ask. I will try my best to cover as much as I can. So first up for Hong Kong land, I think the momentum has kind of picked up again for the recent uptrend. So I think with that here about a level at 786, I think the current momentum we could potentially still see some upside towards about 812 as the next key level, and then afterwards it's around 840 as the next key resistance. So for now, I think price will probably find some support along the 5 SME level, which is currently it's about 749, and then also this previous resistance at 745. Yeah. Then next one for micro mechanics. I think for this counter, the volume is a bit thin. So in terms of technicals, it might not give as good as a analysis, but in terms of the charts, I think it's currently overall it's still an uptrend, but it's more of a volatile uptrend, and then it's at the lower end of the channel support at this area. So and as well as previously May to July last year, there was a bit of consolidation about 153 to 163 this area. So probably we could see some support over here. I think price might do some sideways, but overall it has been still been rather weak since July during the pullback. So I think it will just be a bit of a sideways at around the 160 area over here. Then resistance about 166 to 170. Next up is on iFast. I think iFast is doing is still on an uptrend, and then it's doing an ascending triangle consolidation. So it's like 983 is the resistance, and it has been building higher lows along the way. So I think we'll probably see a higher low build up over here recently. Looks like price is finding support of 955. This resistance holding as support recently. So this will be the immediate support area, and then we might possibly see price hit to test the resistance at around the 980 to 990s area. Then I think overall afterwards it should be able to break out from you to carry on the uptrend given the price. Okay, next one is on Capital DC REIT. So for Capital DC REIT, I think overall momentum has still been a bit weak. Recently, I think it's just range bound between like around 219, 220 as a support, the swing low, and then the resistance likely to be around 225 to about 227. So I think nothing much for now, probably just quite sideways. Next one for the HST, the Hang Seng Tech ETF. I think it's still the price action wise is still well. I think the reversal is still the thesis is still valid since the double bottom at 88 cents and then the breakout of this downwards resistance line, and then you see the price moving above the moving averages, the 5, 10, 20 SME levels is now as well. So most recent price did a pullback and then found support at 10 SME. And then this 91 cents level has this consolidation area has found support. So I think with that, if you can close at this 93.5 cents about there, then we should be able to see some continued rebound upwards towards like 98 cents and then $1.01 next year. So I think HST is still, the price action is still moving well in terms of bullish reversal. Next one for Sembcorp Industries, I think overall nothing much, just pretty sideways, likely to just find some, do some sideways, 596 to about 613 over here. And for SIA, SIA, I think, also nothing much for now. What we need to see is to see whether 640 can hold as support. So this is a horizontal level over here, and around there's also around 20 SME level over here as well. So if this can hold as support, then we might see a range bound consolidation 640 to about 652 area for now. But I don't expect too much. I don't expect much significant price action for now as well. For CNMC, I think it's still locked in the range over here. So it's some key levels at 98.5 cents and $1.04. Today there was a gap up above the 104 level. So with that, maybe we'll see some, if we can continue the momentum upwards, we might see some it test the resistance at 112, the 112 to 116, 112 being the upper Bollinger Band level. So overall it's still kept in range, I think. Nothing much for now. Okay, then next one is on Manulife US REIT. So for Manulife, I think overall it's still holding up in this range, largely between 0.070 and 0.079. So nothing too much for now. I expect some resistance, 0.074, 0.075 this area over here. So yeah, I think it's just nothing much right now. The next one is International Cement Group. So for this, I think price starting to do a bit of a reversal recently when it broke above the 0.043 level, but also previously at 0.049 onwards to like 0.051, there's a bit of resistance over there for now. Yeah, so I think for now, most likely, finding some resistance from the retest and then just most likely sideways with some support at the 10 MA now, 0.045. So I expect some sideways consolidation over here. And I think price will go above 0.043 also as well. So just some sideways, if you can build a higher low over here, then it could potentially attempt the resistance again above 0.050. Okay, I'll take one more question since it's about one. Yeah. Next one for Meituan. I think overall it's still in a downtrend. Then still a very prolonged sideways consolidation, largely between 95 to 108. So but it's been testing the resistance 108 multiple times. And so yeah, we could see another test of the resistance again, and potentially some breakout of the 108 level. Yeah, since in terms of the weekly wise price, a bit better if you can stay 101, 102, the 5 and 10 SMEs on the weekly. Yeah, and multiple tests of resistance, we could see some break above that. So the next level will be around 116. So that will be a gap fill over here. Yeah, and previous horizontal support breakdown level. Yeah, so I think that's all for the TA today. Sorry, I'm unable to take all of the questions, but feel free to tune in down in tonight for more TA now. So I'll cover more over there. Then, so that's all from me. I'll hand over time back to Paul. You have any more concluding remarks?
Yeah, thanks everyone. Sorry, forget to wish everyone Happy New Year. Have a good 2026. Yeah, sorry, there's still like 40 questions that we can't answer. We try our best to just post all of them in our P3 community. Apologize for that. With that now, thanks everyone for your time, and thanks for especially for joining us, and especially your questions. Yeah, sorry we didn't address everyone, but we try to do a hard stop at 1 p.m. And thanks everyone. We wish everyone to have a wonderful week ahead, and thanks again for joining us. Bye bye.